Right now, up to 89% of global trading volume is executed not by people, but by artificial intelligence. A single platform, BlackRock's Aladdin, quietly oversees risk on more than $20 trillion in assets. When the Federal Reserve releases a rate decision, AI repositions portfolios in 15 seconds. A retail investor reading the same announcement needs 15 minutes. This is not a future warning. AI is already quietly controlling financial markets, and the experts behind this investigation argue it may be too late to reverse course. To understand why, you need to see how deep the infrastructure actually goes. Industry analysts now estimate that AI-powered algorithms are responsible for as much as 89% of global trading volume. In the United States, official SEC data confirms that by 2021, approximately 70% of all equity trades were executed by automated systems, a figure that has only climbed as machine learning models have become standard across Wall Street. These numbers are not projections or theoretical models. They reflect the actual flow of trillions of dollars in stocks, bonds, and derivatives every single day, routed and decided by code rather than by people. The growth is relentless. Market research firms project the global algorithmic trading sector will expand from about $25 billion in annual revenue in 2026 to $44.34 billion by 2030, a compound annual growth rate above 15%. North America alone accounts for nearly 40% of this market, with the largest clusters of trading infrastructure concentrated in New York and Chicago. These are not just back-office tools, they are the core engines of modern finance, embedded in every major brokerage and asset management firm. The scale of this automation is difficult to overstate. BlackRock's Aladdin platform, for example, now oversees more than $20 trillion in assets, nearly matching the entire annual GDP of the United States. Aladdin's risk algorithms touch portfolios belonging not only to pension funds and sovereign wealth funds, but also to ordinary retirement accounts and insurance pools. When a single platform's code base can influence such a vast share of global wealth, the risk of concentration becomes more than theoretical. The technology arms race is not limited to equities. In the bond market, surveys show that more than 85% of institutional trading desks are expanding their use of AI-driven execution and analytics. With the United States corporate bond market valued at $46 trillion, the reach of automation now extends to the cost of borrowing for companies, governments, and homeowners alike. These figures are not isolated data points. They reveal an entire financial system where human decisions are increasingly sidelined. The sheer speed and volume of AI-driven trades have redefined what it means to participate in markets. For the average investor, the competitive gap is no longer measured in research or experience, but in milliseconds and access to proprietary code. The infrastructure is already in place, and the numbers show it is only accelerating. BlackRock's Aladdin platform now stands as the central nervous system for much of the world's financial wealth. With over $20 trillion in assets running through its risk models and trading engines, Aladdin's algorithms reach into pension funds, sovereign wealth portfolios, insurance reserves, and the retirement accounts of millions of ordinary workers. This is not a theoretical concentration. According to BlackRock's own disclosures, the platform's coverage rivals the entire annual output of the US economy. Every adjustment, every recalibration, and every automated trade executed by Aladdin ripples through a vast network of funds and institutions, creating a single point of systemic leverage. But scale alone does not capture the full extent of Aladdin's power. The true advantage lies in speed. AI-driven systems like Aladdin are engineered to react to new information in milliseconds, far outpacing any human trader. Tape-level analyses of recent Federal Reserve announcements reveal that within just 15 seconds of a policy release, AI models have already digested the language, modeled the likely market impact, and executed trades that set the direction for the next 15 minutes of price action. By the time retail investors, or even most professional managers, can respond, the opportunity has vanished. In a world where 70% of US equity trades and up to 89% of global volume are routed through automated systems, the competitive gap is now measured not in years of experience or quality of analysis, but in microseconds of latency and access to proprietary infrastructure. This mechanical advantage is not subtle. During a major Federal Reserve announcement in March 2024, market order volume spiked eightfold in the first 15 seconds, with the bid-ask spread widening sharply and the mid-price shifting by over 1% before stabilizing. The pattern is clear. The vast majority of the price move happens in the opening moments, driven by algorithms that can read, interpret, and act on macroeconomic signals before most market participants are even aware a decision has been made. These systems do not just respond to news, they anticipate and amplify it, creating feedback loops that can move trillions of dollars in a matter of seconds. For the average investor, the implications are stark. The infrastructure of the market has become a closed ecosystem, dominated by platforms like Aladdin that not only manage risk, but dictate the very terms of participation. The speed gap is structural, not circumstantial. Retail traders, and even many institutions, are left reacting to prices that have already been set by code, with little hope of competing on equal footing. As more wealth is funneled through a handful of AI-driven platforms, the risks of concentration, fragility, and sudden dislocation are no longer distant possibilities. They are the mechanics of the market as it operates today. AI-driven trading can unravel markets in three distinct ways, each mapped by forensic studies and regulatory reports. The first is the prediction trigger loop. Algorithms scan economic news, like a sudden Federal Reserve announcement, parse the language in milliseconds, and generate trading signals. Because most firms train on similar data and chase the same fleeting edge, their models often react in unison. This creates synchronized surges of buy or sell orders, pushing prices sharply in one direction. The effect is algorithmic clustering. Thousands of systems move together, amplifying volatility far beyond what any single trader could achieve. The second pathway is liquidity withdrawal and ignition. Liquidity, providing high-frequency bots are programmed to vanish the instant volatility spikes. When a predictive signal crosses their risk threshold, these bots pull their quotes in under 4 milliseconds. The order book empties. Aggressive algorithms then flood the market with market orders, triggering a cascade that can wipe out all available bids or asks in less than 30 milliseconds. The ultra-fast extreme events study documented over 9,200 such episodes in U.S. equities, each a flash of instability too fast for human intervention. The third mechanism is feedback-driven quote stuffing. Some algorithms send thousands of orders per second, canceling most within milliseconds, not to trade, but to jam the system and confuse rivals. This artificial noise distorts price discovery, causing overreactions and abrupt swings. These cycles operate at sub-millisecond speeds, outpacing any human or automated kill switch. The 2012 Knight Capital disaster remains a case study in how a single algorithmic error can spiral out of control. A software glitch unleashed over 4 billion erroneous orders in 45 minutes. Knight Capital lost $440 million and collapsed before manual intervention could stop the damage. SEC records show the abort command came more than 30 seconds after the problem began, far too late. This disaster changed how firms think about safety. On June 15, 2024, a sudden shift in the Federal Reserve's outlook triggered a near 10% intraday drop in the S&P 500. AI-powered trading desks from 3 major firms withdrew liquidity within 8 milliseconds. The first kill switch activated at 120 milliseconds, but the index had already plunged 6%. The official review found the crash unfolded faster than any human or regulator could respond. The result was a market crash that moved faster than control systems. A former high-frequency trading engineer put it simply. Once the first signal hits, it is like a fire in dry grass. Everyone's models are tuned to the same data, so the sell-off becomes a stampede. The reality of AI-driven trading is not just a technical arms race among Wall Street firms. It is a structural divide that has left ordinary investors at a permanent disadvantage. Broker execution studies reveal that retail traders lose out on price improvement in nearly 7 out of every 10 trades, with a peer-reviewed analysis placing the average retail loss rate at 68% when competing against algorithmic order flow. The gap is not a matter of skill or bad luck. It is built into the system. By the time a human clicks buy or sell, the price has already shifted, often multiple times, in response to signals no person could possibly see or interpret. Peer-reviewed research published in 2025 draws a direct connection between the rise of machine learning in trading and the frequency of sudden, destabilizing market drops. The study tracked more than 9,000 ultra-fast price swings in U.S. equities over a decade, finding that the introduction of deep learning models in 2017 coincided with a 23% increase in crash-like events. The authors, led by Dr. Yashika Mahajan, concluded that AI systems trained on similar data tend to react in unison, amplifying herding behavior and making sharp downturns more frequent and more severe. They write that AI-enabled trading platforms have fundamentally altered the risk profile of global markets, increasing the likelihood of systemic dislocation. This is not simply academic theory. The International Monetary Fund has issued its own warning, stating in its 2023 Global Financial Stability Report that the widespread adoption of AI in trading and risk management, combined with the opacity of proprietary models, raises the risk of market-wide contagion and abrupt liquidity shortfalls. IMF economist Dr. Michelle Rossi points out that as AI models converge on similar strategies, the system becomes more fragile, not less. She notes that winner-takes-all dynamics can rapidly propagate shocks across asset classes, undermining the resilience of the entire financial system. For everyday savers and retirees, these warnings are not distant hypotheticals. When flash crashes strike, it is pension funds, 401k accounts, and individual brokerage accounts that absorb the losses. The evidence is clear. The architecture of the market now rewards speed, scale, and access to proprietary code, qualities that are concentrated in a handful of firms and platforms. Retail investors are left with the risk, but without the tools to defend themselves. The consequences are not abstract. They are already playing out, trade by trade, in the lived experience of millions of people. AI's reach is no longer confined to equities. In the bond market, the transformation is even more sweeping. According to the latest market access survey, nearly 85% of institutional bond trading desks now rely on AI-driven systems for at least one part of their daily workflow. When measured by trading volume, the figure climbs to 86%. These systems are embedded across pre-trade analytics, real-time order routing, and post-trade compliance, layers that now define the workflow of the world's largest fixed income desks. With the US corporate bond market valued at $46 trillion, this means the cost of borrowing for corporations, governments, and households is now shaped by algorithms, not by human market makers. This expansion has not occurred in isolation. AI's dominance in the bond market is matched by its influence over the structure of the broader indices. Today, just 5 companies, NVIDIA, Microsoft, Apple, Amazon, and Alphabet, make up more than a quarter of the weight in major US equity indices. Bloomberg's 2026 outlook confirms these firms periodically account for over 25% of index value. Because most AI-driven models are trained on similar data and signals, they tend to overweight the same mega-cap stocks. When a correction hits even one of these giants, the algorithms respond in lockstep, triggering simultaneous sales across thousands of portfolios. This feedback loop magnifies the shock, turning what might have been a contained drop into a market-wide event. The scale of AI adoption and the concentration of market power have quietly set the fuse for systemic risk. Peer-reviewed studies and IMF warnings point to a market structure where automation accelerates contagion. As AI models converge on the same strategies, the system becomes more fragile, not less. Herding behavior is amplified, and the line between asset classes grows thin. In the bond market, the same patterns are emerging. Widespread use of AI for price prediction and order execution means that a single macro shock, whether a Fed announcement or a sudden tariff, can cascade through equities and fixed income alike. The groundwork for contagion is already in place. AI has become the infrastructure of finance, not just a tool. With 85% of bond desks expanding their use of machine learning and 5 stocks dominating the indices, the system's resilience now depends on the stability of a handful of algorithms and corporate giants. The next section will illustrate how these dynamics played out during the April 2025 collapse, when the combination of AI-driven herding and index concentration erased trillions in market value in a matter of hours. On April 11, 2025, The S&P 500 fell more than 10% in 2 trading days, erasing nearly $5 trillion in market value. For millions of ordinary investors, the losses appeared in brokerage statements before any news alert could explain what happened. One retiree in Phoenix watched her 401k shrink by 6 figures overnight. She had no algorithm, no warning, and no way to react. By the time circuit breakers paused trading, the damage was already done. The official postmortem traced the collapse to a surge of AI-generated sell orders following an unexpected tariff announcement. 3 major trading platforms, each running deep learning models trained on similar news feeds, triggered simultaneous sell signals. Within seconds, liquidity vanished. Automated market makers withdrew, and quote-stuffing bots flooded the order book, overwhelming human and algorithmic controls alike. SEC surveillance flagged more than 1,000 prediction-driven trades that bypassed pre-trade risk checks. The system's safeguards proved too slow for the pace of machine action. The fallout extended far beyond Wall Street. Pension funds, retirement accounts, and college savings plans absorbed the brunt of the losses. SEC memos released in May confirmed that retail investors suffered disproportionately, with over $2 billion in direct losses across tens of millions of accounts. Lawsuits quickly followed. A coalition of state attorneys general filed suit against the largest AI data brokers, alleging negligence in risk controls and a failure to disclose the true nature of their predictive models. Meanwhile, the White House entered litigation against California, arguing that only federal law should regulate AI in securities markets, not a patchwork of state statutes. Calls for reform grew louder, but progress stalled. The SEC's proposed predictive data rule, which would have required registration and real-time reporting of AI-driven trading signals, was delayed after heavy industry lobbying. Congressional hearings devolved into partisan disputes over market innovation versus investor protection. By summer, the rule was shelved, and no new federal regulations had taken effect. A former SEC staffer speaking on Background described the agency's position as paralyzed by complexity and political pressure. He pointed to 5 targeted reforms now circulating among policy experts: mandatory registration of predictive data providers, annual disclosure of model risk, real-time tagging of AI-generated trades, third-party audits of algorithmic systems, and civil penalties for unreported prediction-driven activity. Each proposal borrows from existing frameworks in Europe and Singapore, but none have advanced beyond draft form in the United States. For retail investors, the consequences are immediate and ongoing. The April collapse was not an outlier, but evidence of a market structure where automation, opacity, and speed have outpaced both regulation and human oversight. The system is now built to move faster than any safeguard can respond, leaving everyday savers to bear the risk when the algorithms misfire. Until meaningful reform is enacted, the gap between Wall Street's AI-driven infrastructure and the protections available to individual investors will only widen. Every day, AI-driven systems execute nearly 9 out of 10 trades, while just 5 technology giants now make up over a quarter of major market indices. Regulation lags as automation tightens its grip, leaving savers, retirees, and retail investors at a structural disadvantage. This isn't tomorrow's risk, it is today's reality. The system governs itself at machine speed, and human oversight is already struggling to keep pace. What safeguards remain when control quietly vanishes?